The latest testimony by the Federal Reserve Chairman Jerome Powell to the Congress that rates have to remain higher for longer and that they may even have to rise at a faster clip has pushed up yields all over the world, and in India, the yield curve mildly inverted yesterday. The percentage of the US market that now expects a 50 bips hike on March 22nd when the FOMC meets has shot up to 76% from 9% a month ago. Likewise, the number of people who now expect 100 basis points of further hikes by June this year from the Fed, taking the Fed funds rate to 5.5 to 5.75%, have shot up to 55%. That is the majority of the market, from only 3% a month ago. What do such sharp rate hikes in the US mean to India? For a 360-degree perspective of the Indian economy, I have with me Santanu Sengupta, the India Economist at Goldman Sachs. Shantanu, thank you very much indeed for joining me. Now, this is becoming a pressure. You know, the US near-term yields going all the way to 5.3 and the expectation of possibly 100 basis point hikes more. What's the Goldman Sachs view first?
Yeah, thanks, Lata. So we have raised our own forecast of the peak Fed funds rate by 25 basis points to 550, 575 now by adding a 25 basis points hike in July. So we have 4 hikes now, all the way up to July, starting with the 25 in March, ending with the 25 in July. The March 25 basis points hike remains a close call, as you correctly pointed out. Some market participants think about 50. Our call still remains that of 25. I think the non-farm payrolls will be the key indicator coming up later in the week. We forecast an above consensus 250K payroll gain, but a softer 0.3% increase in average hourly earnings. Okay. That should be compatible with a 25 or a 50 basis points option, but our call is that of 25 in the March policy.
No, I got that. Actually, I have to come to the more meaty question, which is what does this mean for India? Now, the big fear in the market, obviously, which reflected in the inverted yield curve yesterday, that the Reserve Bank may have to do more than just one more hike. Where do you stand there? Do you think they have to take the repo to 7?
So, see, we have been at 675 terminal rate pretty much throughout. We've called it out for a long time ago. And the reason why we think that 675 right now will be appropriate and we do not need to go any further higher is that you can keep liquidity tight and have the overnight rate hovering between the MSF and the repo to indicate a tightening of financial conditions. That said, we are not expecting the RBI to dial down to a neutral stance anytime soon. So our expectation would be that they hike 25 in the April policy, retain the policy stance as removal of accreditation, which means that they will be able to keep their options open. But mainly, Lata, the view is underpinned by our estimate of core inflation in India, where we divide core into core goods and core services. And while we think that core services will remain very sticky and possibly go higher up by the end of the year, we think that core goods, driven by WPI manufacturing prices already coming down, will probably come off pretty sharply Q2 calendar year 23 onwards. That is, the next quarter onwards, core goods will start coming down. The combined effect should mean that core inflation in India starts coming lower by the end of the year. And therefore, we think that 25 in April will be appropriate for the RBI.
Okay, now this is giving rise to 2 or 3 questions. First, the shorter one. There is this worry about now cereals and milk inflation. That's food inflation, basically, also remaining sticky. You don't think that can push up? There are a lot of economists who have upped their inflation forecast, even for the one that will come out next Monday. The expectation is it could be even 6.3%. So are you upping your inflation forecast for this quarter and for the FY24 year?
So again, for the calendar, for the current quarter, we were already at 6.2% when the RBI was calling for 5.7. The January print came in at 6.5. We are around 6.5 again for the February print, and thereafter we think that the base effects will kick in to bring the March number lower, and you will go a little bit lower in the next quarter. But nowhere close to where the RBI is projecting at 5% for the next quarter. So we don't see a reason to up our forecasts right now, but point taken on the upside risk. So milk is clearly an upside risk, so is cereals. We are pretty sure that the vegetable prices, which had caused the lower inflation in the previous quarter, which was quite exciting for the market, but we were sort of the view that the central bank will look through it. We think that the vegetable prices also will revert, especially with weather conditions changing. It's getting quite hot and so forth. But look, the mean reversion in food prices, etc., is something that the central bank will look through. I think the RBI has been extremely focused on core inflation. So the stickiness is core in core is what they will be looking at carefully.
Okay. Now, the other worry of the market is that if the Fed goes on increasing, then the Reserve Bank may have to move a bit on account of the rupee. Already yesterday, we had a lot of traders telling us that exporters don't want to give away their money because they're earning a good 5.3% on dollar interest rate. FIIs may also start thinking like that. I mean, if I'm getting a risk-free return of 5.5% on US one-year yields, which could happen very soon, why would I come to India? So could there be a balance of payments problem which can push the rupee higher, therefore forcing the Reserve Bank's hand to raise rates?
Yeah, so on the current account side, actually, we brought down our current account deficit forecast to 2.4% of GDP from near about 3% of GDP earlier in the week. We think that the services exports, which have been growing significantly, and it's increased to 9.8% of GDP in the second half of calendar 22 versus 7.4% of GDP on average between 2015 to 2019. That's been mainly driven by software and business services. And this is despite a slowdown in US and Europe. Our view is that the services exports growth has decoupled from revenue growth of top IT companies. So earlier you used to have a very tight correlation between the top 5 IT companies' revenue growth and services exports. Over the last year or so, the revenue growth has declined, whereas the services exports have held steady, which means that exports for us is getting more broad-based, and probably we are moving up the value chain also in other software and business services. And that is providing the RBI with some cushion. 2.4% of GDP in our mind should be manageable. We'll still run a balance of payment deficit in line with what you are saying on flows, etc., being weaker than anticipated. But around 0.5% of GDP on the balance of payments deficit should be manageable by the RBI given the reserves. And therefore, very rightly, that does not impose another binding condition on the RBI to hike further because of the external balances being weaker. So it's not as weak as what was being anticipated earlier, probably because of the services exports.
No, take your point entirely on the way services exports have grown. In fact, if you only looked at the January number, we are already at a current account surplus. The trade plus merchandise goods plus services, the deficit is hardly $1 billion. I take your point on that. But, the market normally looks at flows. Whatever the year-end current account deficit number, the daily flows become important. And if this, the fear in the market, at least I picked up that very widely yesterday, sell in May and go away. Around that time, you're going to have, Fed rate hikes probably at 5.5% or thereabouts. Can it create a temporary butterflies in the stomach, taking the rupee over 83? Are these in your calculation?
Yeah, sure. So, look, we are in the near term, we are calling for a slightly higher dollar rupee, but thereafter we think it's going to be flattish to slightly appreciating. We are not calling for large appreciation, even if you get, let's say, more inflows in the later half of the year, because in this kind of a cycle, we think that the RBI will accumulate reserves. But absolutely correct our view is absolutely in line in terms of, slightly higher dollar rupee in the medium term. Look, the real interest rate differential between India and US is narrowing, or is going to narrow over 2023, which is likely to pull down the FX forward premium as well, which can create or which can reduce the carry attractiveness of the currency, some speculative position build up from time to time. The other point which our global strategists have been outlining is, while our core view globally remains that of a dollar downtrend, it also means that the dollar downtrend this time is going to be more shallow with bouts of dollar strength like we are seeing in the current episode, right? So as the Fed repricing takes place, you will have these bouts of dollar strength, which will pull probably emerging market currencies slightly weaker. But our core global view still remains that of a dollar downtrend, and therefore we think over the year, dollar rupee will be more flattish, whereas there can be some near-term upside risks, as you pointed out.
Okay, you rest our fears, you quell our fears a goodish bit. Okay, let me quickly come to growth. Now, rate hikes, Fed at 5.5 to 5.75 could mean a slowdown. Wouldn't that impact growth? I've seen a lot of economists coming with 5.5 and 5.6. You're not so pessimistic about India's growth next year?
We are relatively lower than consensus for FY23, whereas we think that you'll have this base. In general, growth is doing better globally. That is why the Fed is able to hike to the extent that the market is pricing in now. In recent months, globally also, we have been arguing that the drag on GDP growth from, especially US growth, from last year's fiscal and monetary tightening is fading and not growing. And that means that the key risk for the economy is not really an imminent recession anymore. So a recession probability is about 25%. So our view, therefore, on India is that in the next year, we'll see about 6% plus growth for fiscal year 24, while for the fiscal year 23, we are slightly below consensus at 6.6%. Consensus will be closer to 7%, and the advanced estimates also at 7%. Again, that is underpinned by our view that the capex cycles should slowly pick up. Manufacturing companies have deleveraged, capacity utilization is getting higher, the bank balance sheets are stronger, and government capex is also picking up.
Okay. Well, fair enough. We hope that optimism plays out. The Reserve Bank is even more optimistic than you are at 6.4% for next year. But on the street, I'm still hearing 5.5. Thank you very much, Santanu Sengupta. That's some very optimistic takeaways, that growth next year will be in the 6 handle, that the rupee should be able to go through, despite the Goldman Sachs view that there is 100 basis point of rate hikes more from the Federal Reserve. The rupee at 83 for this quarter in 3 months, and for the remaining 6 to 12-month horizon, they are expecting it to actually strengthen to 82. That's a benign view, and the market should take it very well. Wrap up on Bazaar. Chart Busters up.